Good morning, good afternoon, good evening, wherever you happen to be located. Welcome to today's webinar hosted by Retirement Learning Center and the Retirement Advantage. I hope everybody and their loved ones are about to gear up for a nice holiday period as we come towards the end of the year here. Today, we're going to be discussing practical and tactical actions for small business owners. My name is Travis Avery. I'm the Marketing and Communications Coordinator for the Retirement Advantage, and today's keynote speaker is John Carl, founder and president of Retirement Learning Center, or RLC for short. John is a veteran of the retirement industry with over 25 years of experience and considered the nation's preeminent thought leader on retirement issues. You may have seen John featured on CNBC, CNN, Forbes, ABC News, The Wall Street Journal, USA Today, the list goes on. He's also a founding lecturer for the Retirement Advisor University at UCLA Anderson School of Management, Executive Education, and executive director of the Plan Sponsor Institute, which is the education and training arm of Plan Sponsor. John also serves on the Government Affairs Committee for the National Association of Plan Advisors. In addition to John on the call today is McGregor Hall of Deschutes Investment Consulting LLC, who many of you may know. I believe Mac has a couple additional introductions here in a moment. But before we start, I just want to take a moment to review the functionality of today's webinar. All of you that are here and established as an attendee are on mute to avoid potential interference that may distract from everybody listening to the webinar. You do, however, have the ability to submit questions or comments throughout the presentation using the questions and chat panes on the control panel on the right-hand side of your screen. Your questions will be answered at the end of the webinar during a Q&A segment. If we are unable to answer your question due to time constraints or otherwise, a representative will be able to reach out to you individually. In addition, follow-up efforts will be conducted by Deschutes and RLC, including an access link to view this recording, as well as any other supporting materials. On the RLC side of things, for those of you in attendance that are requesting CE credit for any of the designations offered, you must be logged into the video/presentation portion of this webinar for the full 60 minutes and answer all the polling questions to qualify for that credit. RLC will then be emailing those certificates, and I'll break down that process in a little bit more detail at the end. Also, please complete the short evaluation survey that will pop up at the conclusion of this course. We're always looking for ways to improve and make these experiences even better, and we really appreciate your feedback. So without further ado, here's Mac.
Hi, I'm McGregor Hall from Deschutes Investment Consulting. On behalf of my co-sponsors for this event, Geffen CPAs and Brown & Brown Northwest, welcome to the CFO Roundtable. This is a forum for financial professionals to come together and to share thoughts, to gather and meet each other on a quarterly basis. And normally this forum would be held in one of our sponsors' offices. Specifically, this one would have been Geffen. They have a beautiful conference room. But due to the restrictions to the pandemic in the state of Oregon here, this is going to be virtual only. In future sessions, we hope to have them on premise. John Carl has already been introduced along with the Retirement Learning Center, so I won't go over that again. But I will just say that the CFO Roundtable is a forum that's dedicated to bringing timely subjects that are important to CFOs, controllers, and business owners. Today's session is in particular very important and timely, and John will cover not only the named presentation, but also a little bit on the Secure Act. As you know, there's been a lot of legislation being pushed through these days, so this ought to be pretty interesting. So in the future, we will hope to have these things on premise. We will also hope to get CPE credit, but the primary goal is education and sharing of thoughts by professionals and thought leaders in our industry. On behalf of Brown & Brown Northwest, Geffen CPAs, and our friends at Mass Mutual who brought you this, thank you very much.
Thanks, Mac, and thanks everybody for joining us today on our virtual CFO Roundtable. As Mac said, I've been in the business really since 1989, so a long time. Mac, I get to sit on the Government Affairs Committee for the American Society of Pension Professionals and Actuaries. And I paused there for the awkward silence and laughter inevitably in the conference room on the other end, but I get the same treatment in my own home. But nonetheless, every dog has its day, and there's a lot going on in our industry. So we're going to run you through one of our decks today. And as Max said, as we were talking before this, sitting in that government affairs committee role, obviously Build Back Better passed the House. You're going to see a materially different version in the Senate. You're going to see Secure 2.0 probably be its own standalone piece of legislation. So we'll layer in that and obviously leave plenty of time for Q&A. As Travis said, who's driving the bus here, there's some polling questions along the way, not only for your entertainment, but for your CE purposes. Please, if you have any questions, the little question button at the bottom, just type them in as you go, and we'll address them there at the end when we get everybody off the mute. But the program today, Retirement Learning Center, we've been around since 2003. We're an independent third-party ERISA consulting and training firm. I used to run the ERISA business for Alliance Capital, Alliance Bernstein for many years prior to that. But we don't run plans. We don't run money. We're not a TPA shop. We just, are a consultancy in the industry on technical ERISA questions. And the good folks at Deschutes use us periodically when they need to navigate some of these questions. But we get about 1,100 calls a month into our, ERISA desk. So what we did is we kind of segmented out those calls that are coming in and try to bring some, not just mumbo jumbo, but some actual practical light to what's going on in Washington and some of the things that, need to be addressed along the way as part of that. So as we run through the next slide, the agenda, it's coming to an end here, but we'll talk about the Ppp Loan Program in the sense of that if you got one, if you took advantage of it and you were fortunate enough to do so, we'll run through getting to forgiveness, which is really an accounting entry, and really how to maximize that PPP loan. So for those of you who have it, if you haven't gotten forgiveness, or even if you have, there are some amendments that can be made there that might be very attractive. The next thing that we'll talk about, which might apply to some in the room, is some of the tax legislation that's out there, and we can expand that into your questions depending on the type of organization you are. But if you're a pass-through, we'll talk about the one thing that is not part of the current administration's changes from the previous administration related to tax code, and that's the retention of Section 199A, or the qualified business income deduction, that will still be there. So we'll talk a little bit about that. And the theme here is, if you are, a business, a small business, or, and that's what the theme of the presentation is today. And again, if there are questions, if this does not fit your business, please ask away on anything that might be relevant. But the objective that we try to do with our consultancy and working with folks like Mac and Phil and his people there at Deschutes, it's really not, what you earn as a business, it's what you keep. And having a well-designed overall benefit scheme, which includes an ERISA plan and maybe some other things, is really at the essence of how do you keep more of what you earn or be more efficient on a business. And of course, that's what you as CFOs do day in and day out. We'll talk about what certainly is germane now, which is trying to keep people in the saddle in a tight labor market, or maybe a difficult labor market where we see people not wanting to work quite as much as they used to. But how can you take care of key employees best? What strategies and structures are available to you to retain key talent and do that cost effectively? And then in general, how do you have a more better productive workforce in this wacky environment that we've been in? And we'll talk about some strategies embedded in there. So for CE purposes, the next slide are learning objectives. We'll talk about PPP loan forgiveness and maximizing that. We'll understand the basics of 199A deductions and can expand into other parts of the tax code if you like. We'll talk about using ERISA plans to achieve your ultimate business goals and helping you keep more of what you earn or be more efficient in that allocation thereof. We'll talk a little bit about plan governance, which at the end of the day, as a CFO, you care about earnings and profiting, but of course, risk is another big issue. And most of the lawsuits that you see around ERISA you'll see suits about excessive fees. They're not really about excessive fees. They are about excessive fees, but what they are is they're governance lapses. It means that you have a consultant on your plan who, maybe in most cases, the investment choices are not in question. It's the class or the share class or the type of vehicle that investment was in that could have been found at a more cost-effective level. And that's a governance lapse. So making sure you have a governance process or an organization that can run your plan governance is important. We'll go through executive comp arrangements to lock in key employees, and then broader financial wellness programs that can really help you have a more productive workforce. And, you know, obviously people who are financially secure and sound generally tend to show up at work more, call in sick less, and retire on time. All very good things. So first topic that we're going to talk about today, which hopefully applies to some folks out there, is the PPP Loan Program. The PPP Loan Program is an interesting one and a good one. And, you know, obviously we've been in the throes of a pandemic. Hopefully we're coming to the end, although now the news media is pointing out that we're seeing cases rise up a little bit here before Thanksgiving holidays. But, you know, at the end of the day, the PPP Loan Program was designed out there and really well needed, you know, to get businesses, you know, during an unprecedented pandemic, you know, the necessary proceeds to keep operating. And that was fine. And then it was further refined, and draw two, or the second window of the PPP loan, was also extended here, you know, to be utilized this year. And depending on the business that you were, I hope all of you that were eligible for it went after it and received it. And hopefully you were in a position where maybe you didn't necessarily need it. We get a lot of calls at the desk saying, hey, I got the second draw on the PPP loan. I didn't really need it for what was the situation in draw one. Am I in trouble? Well, the next slide will kind of show you is no, you're not in trouble at all. And really the best practices for your PPP loan is to segregate it and document that each time you did a payroll that you drew off of that PPP loan bucket, if you will, from an accounting entry to use it for payroll. But the way we came out on this out of Washington is only 65% of that PPP loan, in order to achieve forgiveness, had to be used for payroll. So I can tell you in the Retirement Learning Center, what I just outlined is exactly what we did. We kept that PPP loan in a separate account. Each time we did a payroll, we documented what the payroll was, and we tapped the you know, the PPP loan transfer, if you will, which is just a paper accounting entry to utilize it for such. Once you hit 65% utilization, and again, you can go back and do this in your books, that's all you needed to do for payroll as related to the PPP loan. What do you do with the balance and still get forgiveness? Well, the other 35% can be utilized to, number one, best idea in my book, is to enhance your retirement plan offering with things like profit sharing or reinstating matches, or maybe even jump-starting a cash balance plan that, of course, would have to have some permanence. That thing's going to have to be in place for at least 3 to 5 years. But nonetheless, you've got this additional, you know, amount of proceeds that if your business recovered and you still got that second draw, that PPP loan, you can use 35% of it for those things, and also healthcare, employer-related costs for healthcare, and state and local taxes. So there's a reasonable amount of money that can be utilized for non-payroll, and I'm not sure your lender has always, you know, talked about that. You know, this slide is a little dated, but, you know, you've got 10 months to apply for forgiveness or reapply and mandate, you know, getting your forgiveness. If you're having trouble doing that, please reach out to Mac or Phil at Deschutes, and we can kind of help you take a look at that, because having the proper forgiveness package really can be, you know, quite constructive and utilized above and beyond just the payroll aspects of it. So I want to make that very clear. And we do a lot of just, you know, consultancy work, helping to make sure you're taking maximum advantage of that and using it as effectively and efficiently in your organization as you possibly can. So let's move a little bit in the next section into some of the tax stuff. And again, this being a focus on the small business owner side of the equation, we're going to talk about the part of the tax code that came in from the New Jobs and Tax Act, which is a permanent part of our tax code. It's called Section 199A of the tax code. You know, the New Jobs and Tax Act was widely known for reducing the corporate tax rates in our country. And there was a lot of consternation about, you know, why are we giving corporations tax breaks? The fact of the matter is, you know, what they did is they actually levelized the U.S. corporate tax rate with the rest of the G7. So, you know, we didn't really create an unfair advantage for our corporations, but we did levelize that. And there's talks about, of course, increasing that potentially and back and forth, and we'll see where we end up with on that. But the byproduct of that is, of course, you couldn't give a break to corporations without addressing the large majority of employers in the United States by the numbers are small businesses. So our small businesses were granted Section 199 of the tax code and the qualified business income deduction as part of that. So I'm going to run through some slides here, and hopefully this applies to you. But on the next slide, we'll say who is eligible for this 199A deduction, or the QBID, and that's any individual or organization that has qualified business income. And of course, in Washington, it is based on limits and phase outs, and this is going to stick around next year, but there might be some tightening of that, but we're still going to have, by and large, 199A deductions available. And the next slide shows you the basic general rule of 199A. It's a deduction of up to 20% of your qualified business income, because remember, if you're a pass-through, you are not taxed at the entity level. The term pass-through means you have pass-through income that is therefore passed through, and you are taxed at your ordinary income tax bracket on that. The 199A qualified business income deduction is eligible for up to a 20% qualified business income deduction prior to it being passed over to your ordinary taxes. So somebody who has, a total, ordinary income of, $150,000 from all sources, but 100 of it is qualified business income, that 100 could get up to a 20%, or in this case, a $20,000 deduction before it hits, their personal tax bracket. And we're going to go through some of the subjectivity to it. But the next slide kind of shows you who is eligible for this. This is our sole proprietors on their Schedule C, partnerships, Ks and K1s, LLCs, S Corps, and then there's other carve-outs for real estate investors on Schedule E, REITs, and qualifying cooperatives, but it's generally our traditional pass-throughs. And the next slide kind of shows you where we look for that stuff. But before we get there, we're going to run you through a little bit of ERISA jeopardy to see that you're paying attention and make sure you get your, CE credit here. So what is the maximum qualified business income deduction that is allowed? Please select one of the following. Is it A, up to 20% of qualified business income? B, at least 20% of qualified business income? Is it C, up to $20,000? Or is it D, up to 25% of qualified business income? We'll see if you're paying attention. Give you a moment to submit your answers here. Travis, what did we come up with? Well, we got 88%, saying up to 20%. The other saying at least 20%. The right answer is A. It's up to 20%. It could be less. We're going to run you through some tantalizing slides to get you up to speed on exactly what it is. On the next slide, we'll start going through. Here's where we start getting those numbers. If you're a sole proprietor, we're going to be looking at your Schedule C. If you're a partnership, your KK1. I'm from the great state of Pennsylvania. Your farmers on Schedule F. Maybe, I don't know if wine growers in Oregon have Schedule Fs or not, but maybe they do. And then, your 1120Ss for your S Corps on the W-2 side of the equation. So that's where we go and we look for these numbers. And again, really what we're looking at is what type of income does the organization have and how much is it throwing off? So the next slide shows you there's, generally two types of income. A sole proprietor is going to have income. An S Corp, you might have folks taking W-2 income, and then separately for the partners, potentially pass-through income or the business owner. The next slide shows you what we're talking about in terms of these income thresholds to get up to a maximum of 20% deduction. So if you are, a pass-through individual and you're a joint filer and your income from all sources is below 329.8, then do not pass go. You're already scheduled for 20% deduction, no brainer. If you're a single filer, that number for an automatic 20% is 164.9. So you start getting, hopefully you're starting to get, the understanding of our theme is like, well, those aren't, massive numbers. How can you get your adjusted gross income down below those numbers? And we'll talk about phase outs and thresholds in a second. But you can start seeing the objective here to maximize or get a qualified business income deduction is going to be all about reducing within these income caps, and we're going to talk about the thresholds, getting your numbers down within them. And the only way there's a couple of ways to do it. One of the best ways, though, is to have the well-designed ERISA plan where you can defer as much income as possible, or other type of schemes that you can do that in. So the next slide, though, does show you that above and beyond just the income phases, the next thing that Washington wanted to make you determine, or your CPA determine, is are you a specified service, trade, or business or not? So specified service, trade, or businesses are going to have further limitations based on generally, I guess, Washington saying their ability to earn lots of money. And that's our healthcare, our legal and accounting and actuarial services, our consultants, our athletes and our entertainers, and obviously financial advisors fall into this specified service, trade, or business. So there's going to be some hard caps on getting any qualified business income deduction if you're on that side of the ledger. However, if you're a non-specified service, trade, or business, architects, engineers, retail, manufacturing, anything in construction, and again, this is where a great CPA comes into play, is how are you going to be able to be categorizing yourself? Well, you want to be trying to categorize yourself within appropriate limitations as a non-specified service, trade, or business, because there's an unlimited ability to at least get some part of your qualified business income deduction there. And that's the next slide. The next slide is going to show you these phase outs. The phase outs, remember, the hard caps to get the full 20% deduction, $329.8 for joint filers, $164.9 for single filers. The phase out to get a partial QBID deduction goes up to $429.8 for joint filers and $214.9 for single filers. And again, going back to the next slide, your specified service, trade, or business, here's where we start taking a look and saying, okay, which one are you? Are you track 1, track 2? And the next slide kind of shows you why that is important. Because if you are a non-specified service, trade, or business, great. The next slide will kind of show you, though, that if you're a specified service, trade, or business with income above the thresholds, on the next slide, you'll see that there is no 199A deduction allowed for you. Yeah, however, if you're non-specified service, trade, or business and you're above the threshold, then a formula is going to kick in and your tax preparer is going to help you navigate that. And there's room for a potential deduction there as well, too. So the IRS forms on the next slide that we're talking about filing there are 8995 and 8995A, depending on your situation. So 199A is sticking around. Again, the best way to navigate that is to know, what your income is if you're in this qualified business income throw-off type of an organization, and how do I work with my financial organization on a scheme that helps me defer as much income as humanly possible to get within those caps while working with my CPA. So that's the version of the concert that we try to assist on and coordinate with Mac and Phil and the team, obviously working with the organization and their tax firm as well too. So you're getting into the next part of the program for us is, how can we as a business, in this case a small business that we're talking about primarily, keep more of what I earn? Because that is really what it's all about. I mean, when I get to interact with a lot of financial professionals, and it never ceases to, amaze me how a financial consultant will say, well, my investment portfolio, I beat the S&P 500. I'm like, well, that's great, but how much did your client keep? Doing it tax efficiently is really, at the end of the day, keeping what you earn is the key. And the next slide will show you that from our perspective at Retirement Learning Center, no surprise, achieving an ideal plan design at your organization is at the heart and the key of keeping more of what you earn. That is the tried and true stipulation that's there. And, if you're a small business, you have many different types of plan designs that are available under the world of ERISA to help you achieve both your personal and your organizational goals. And most business owners are simply just not aware of these various design options that are available to them because they come in all different kinds of flavors, and then there's nuances even within them. So plan designs can range from anywhere from solo case to simples to SEPs, all the way up to full defined benefit or hybrid defined benefit cash balance plans. But understanding what your business cash flow is, how predictable it is, what your employee demographics are, and what your objectives are as the owners of the organization, that is what is needed on our side. And we're that third-party ERISA consulting firm that works in concert with the Deschutes, who actually would implement that and bring it to light for you. We're just the ones that kind of blueprint it out for you. And the next slide will kind of show you a practical takeaway that if you choose to engage in your homework assignment, then we would urge you to fill out our plan suitability survey. And I promise it's going to take you 3 to 5 minutes at most. And we're going to ask you some basic questions. Is what type of an organization are you structurally? Tell us a little bit about your employee census, if you will. Tell us about your current plan type that you have in place. Don't forget that if you don't have a plan type in place, then undoubtedly you are probably going to be required to have one. Obviously, down the road from you in California, businesses who have 50 or more employees this year, all businesses that are registered with the state, and if you had 50 or more employees and you do not have a plan, then you have the Cal Savers plan this year if you don't initiate one yourself. And that number in California, by the way, is going all the way down to 5 employees or more. Oregon, I believe, has its own kind of version. It's kind of like a Roth IRA type of a program. And as part of Build Back Better, and we'll see whether they have the juice to get this through. It's certainly being discussed and bantered around that the current administration would like to have a federal requirement for all businesses with 10 or more employees in it to have a plan. We'll see whether that goes through. I don't give it a tremendously high probability right now, but you never know. We'll see how the votes kind of line up and where we're at. But you can be assured that the states are stepping in. There's 17 states that have a Cal Savers type blueprint around them, and the trajectory. And again, coming out of Washington, I got to say, whether you're a Democrat or a Republican, the concept of ensuring the coverage gap is met, meaning that we get all Americans access to a qualified retirement plan. That's where legislation is going to be going here. So this plan suitability survey essentially says, if you're going to have a plan, or if you do have a plan, or you're going to be required to have a plan, give us a few data points and let us at Retirement Learning Center independently blueprint that for you. Again, we don't run plans. We're not a TPA shop. We don't run money. We're just a pure consultancy. And today we're brought to you by the good folks at Deschutes, who are utilizing us in this capacity. So we're happy to help you work on the ERISA design, because you can do some pretty interesting things. And the next kind of slide shows you a little bit of what are the options that are available in a normal small business environment. Well, you can have SEPs, those are IRAs though technically, and have various limitations, in terms of what you're able to contribute based on 25% of eligible payroll. I would tell you a solo K might be a better option for that, and actually even have better creditor protection available. There's simples, there's 401ks, and you can start layering in profit sharing plans, and profit sharing plans can be addressed with new comparability rules, which is a legal way to discriminate where your profit sharing allocation goes. And I say legal discrimination, meaning you're going to get a dollar for dollar tax deduction on your profit sharing contribution. That's going to help your 199A conversation, of course, by the way. But where that profit sharing gets allocated can be legally done so and skewed towards folks who will have had the longest tenure, the people that are in the highest rate groups, if you will, by job function, and geographic location. So on down the line, there's legal ways based on age, job function, et cetera, for us to, just show you some designs, and then you work with a good actuarial firm, like the folks at TRA on the line that can help you do this with the 401k profit sharing. And then you start getting into looking at the defined benefit world. If the company's really humming along here, and a lot of our professional organizations do this, and firms that are rebounding well in this economy, then you're talking about traditional pension, or maybe more likely, you're talking about a hybrid version in a cash balance plan. We're going to talk about that in a second here. But the next slide kind of shows you with a brass tacks. That question that we ask, what kind of an organization, what type of plan do you have in place? How much can you contribute to it? Really becomes key. And from there, then we start backing into what type of plan designs, based on what you're telling us, make the most sense, and start educating you on those variations and themes. And you can see in the lower left-hand part of the equation, where we're talking about defined benefit plans, now you're talking about maximizing your 401k and profit sharing, and you still have cash flow that you're able to and want to defer and shelter from taxes. That's when you're getting into the defined benefit conversation. And then there's the traditional DB plans that are out there, which of course is your corporate liability. And then there's the hybrid, or the cash balance plan, which still is a corporate funding situation, But again, we're going to talk about this a little bit. You now have, as you come down to year end, the interesting thing as part of the Secure Act 1.0 is you now have a rear view mirror with which to write these plans. Meaning if you don't currently have a profit sharing or cash balance plan, you used to have to, guesstimate and rush, and you'd have to have it implemented, and all lined up by calendar year end. The Secure Act 1.0, which was very ill-timed and came during the pandemic in 2020, has given us now a new rear view mirror lens where you do not have to initiate or fund or have these plans all set up until the time in which you finalize your tax filings for that year. Meaning, no sooner than April 15th would you have to have that profit sharing or cash balance conversation, structure, plan, funding done. And if you're filing extensions, you could be doing, for example, this year's plan funding to reduce your taxation situation all the way up until potentially the third quarter of next year when you're finalizing your extensions. So we now have a rear view mirror to help you with some time to work with your consultancy and your tax preparer to figure out, hey, what's our situation? What does it look like going forward? So it really gets into a healthy CFO conversation from a cash flow perspective, intersected with an ERISA design that makes sense and on the tax side of the equation. And I'm going to run through a couple of slides on the next about this whole cash balance conversation. But before we get there, I want to hit yet another ERISA Jeopardy question. So we make sure all you CPAs get your CE. You have to run through these polling questions. So second ERISA Jeopardy question, which type of plan allows for the most contribution flexibility? Select from one of the following. Is it A, traditional or Roth IRA, a B, a SEP plan, C, a simple plan, or D, a profit sharing 401k? Which of the following plan types allows for the most contribution flexibility? We'll give you a moment to submit your answers. All right, Travis, what did we come up with? Traditional Roth, got some answers. SEP plan, got some answers. C, profit sharing 401k. D, that's going to be our winner there. All of them can get you decent contribution figures, but if you go back to the previous slides, you'll see that, that profit sharing 401k, can get you all the way up to your maximum 415 contribution limits. But we're going to go into the next section, which is really the money section. And that's how we can really, jack up your total overall funding. And that's where we start talking about cash balance plans. So cash balance plans, number one, the first thing we need to realize about them is they're hybrid defined benefit plans, so they need to be permanent. Meaning you can't just say, hey, I'm having a really good year this year, I want to set up a cash balance plan. You have to make sure that you're going to be able to continuously fund that cash balance plan. And we work with actuaries to help you design and understand, the funding side of the equation. But it is generally pretty, manageable and doable to establish this cash balance plan. It's 100% company funded, but it is portable. There's the difference between that and a traditional DB plan, where the company is going to guarantee eligible employees that specified benefit, but the new comparability rules do apply to those contributions, meaning it's very similar to your profit sharing contribution. If you're allocating 100 grand, you're going to get a dollar for dollar tax deduction, and you've already done so here on the 401k and the profit sharing side. Now you're getting another deduction, further dropping down that reported income number, and it is being allocated, that cash balance contribution is being allocated again based on those same new comparability rules, meaning job function, rate group number 1, 2, 3, or 4, rate group number 1 has a higher weighting associated to it. Age and length of service is going to skew that contribution number more into that type of a group. So job function, age, length of service, and geographic weightings. In most cases, what we find, partners and business owners can retain 70, 80, 90% of every dollar that is contributed in their own individual account, with getting a full dollar for dollar tax deduction in this cash balance scheme. So you can imagine, if we're looking at a higher tax environment going forward, that this makes a lot of sense. So the next slide kind of shows you how do these cash balance plans work. Well, the cash balance plans work again by the employer making, the maximum eligibility and vesting requirements have to be established in the plan document. And earned income is what is considered here. How much are you throwing off on an income year? So you can have some flexibility in what you're contributing based on your earned income, but you are going to be working with a TPA and an actuary to do the analysis of this employee census, again, for the new comparability considerations that we talked about. But you're going to be on the hook for an annual contribution at the end of your fiscal year. And you're going to have to keep this as a quote unquote permanent plan, meaning you're going to want to make sure that you're going to be able to make these contributions for at least 3 years, preferably 5 years. But if you get past 3 years and something changes within the organization, not a problem to collapse it. If there is a drastic change in the organization, of course, we can help you navigate that as well too. The assets are going to be invested though in a single account, like a trustee account. And the objective of the assets being invested are quite different than what you're trying to achieve with your 401k plan committee. Right, your 401k plan committee is, again, trying to get your participants broad access, and you're trying to help people grow money. Now, maybe you're trying to also offer some income benefits to them where they can draw down income. But when you're running a cash balance plan, you're going to make sure that you're having a steady Eddie type of run. Because if your cash balance pooled account grows dramatically, it's going to limit how much you can fund in the following year. If your cash balance plan underperforms dramatically, you can run it unfunded, but over time it's going to increase your required contributions over time. So the way you run your cash balance plan, again, it's very defined benefit oriented. It's something on the books of the organization, and you're going to want to achieve close to a standard steady crediting rate associated with that plan. Ballpark, you can play around with that, talking with your actuaries, but minimum 3, probably more like 4 or 5% is what we're talking about there on the crediting rate. But the next slide will show you that a winning combination is combining maxing out the benefits of your 401k with the safe harbor if you're running into top-heavy testing issues, layering in that profit sharing plan and using new comparability rules. And then if the company is doing very well, then that's when we layer on the cash balance plan with the same approach that we did with the profit sharing. Both plans are separate vehicles, but are tested together from a compliance purpose. So again, very important that we understand what the census of the organization looks like. And the next slide will show you the results that can be achieved. Owners here in a situation, or partners that we're talking about here, again, remember one of the qualifying variables for skewing contributions of the profit sharing and the cash balance is age, job function, length of service. You can see, if you look in the upper left here, an older business owner or partner group, if you will, age 60 to 65, they're maxing out their 401k. You can see they're getting 26 in because of their catch-up contribution. Their max with 401k and profit sharing gets them up to 64.5. Again, that's just a function of the catch-up contributions. If you layer in a cash balance plan, depending on the actual age, you're looking at a total deferral, so a reduction in taxable income of $260,000 allocated for that business owner or partner, totaling $324,500, which is being knocked off of their taxable income. And this ties, of course, back into our 199A conversation. So you can see, if you're trying to achieve maximum deferrals by doing so in ERISA plans, we have a lot of flexibility here. So if cash flow success is one of your problems and paying too much in taxes, we got a lot of tools in the bag that we can help you explore, and get you into the right place here. So again, the next slide kind of talks about what I talked about before. Again, you're looking for a targeted rate of return with direct correlation to the interest crediting rate here. This is where your actuary comes in. And then your investment manager, your advisory firm, is going to run the money, and they're going to try to have, a standard, continuous, steady rate of return. They're not going to try to shoot the lights out, because if they do, it's going to limit the amount you can put in the following year. They're not going to put you in the most volatile as well too, because they don't want to see you underfunded in the plan. The interest crediting rate impacts your testing, and generally 5% is what you can assume, although your actuary can help you, determine what that is. And the next slide will show you who are some of the ideal candidates for these cash balance plan type structures. Well, it's our owner only plans that are doing very well. Our medical groups, certainly the healthcare companies, if you haven't explored it, it might or might not be right for you, but certainly it's worth bringing out the pen and paper and letting us certainly, run a blueprint for you about what it could look like in a medical group. Some very attractive programs out there. Professional firms like CPAs, law firms, financial service practices, consultants, hedge funds, IT organizations, any organization that is successful and demonstrating they have some form of permanence to that cash flow, and their primary, I don't know if this is a technical ERISA term, Mac, bitch, is that they're paying too much in taxes. This is when we start blueprinting these and see if they might make sense for you. Consistently highly profitable professions and businesses are what we're talking about here. So of course, as a CFO, if we can show you that one of these designs might be appealing, and again, blueprinting them is just a good process to go through one way or the other and see if it might make sense for you. Then the next thing that we get from a smart CFO, like all of you on the line, is, all right, well, this sounds pretty great, but I've read the horror stories. I'm moving up the complexity in the plan design strategy. What is my liability? Because the only thing I hate more than declining profits is higher risk. Well, liability management comes part and parcel anytime you're working with the folks at Deschutes, and we support them in the endeavor here with having a properly plan governed type plan. So the next slide will show you the elements of a good plan governance policy. I mean, you can hire just about anybody to run your plan who's going to do the upper right, a bubble there. They're going to spend an inordinate amount of time talking about the investments in the plan, and that's great. It's very important. Having good investments in your plan is part of your fiduciary responsibility and your liability. So that goes without saying. But if you look at the other elements on the checklist here, this is what good governance is all about. Undoubtedly, in your CFO role, you're probably playing a governance role at the organization in terms of its management, its running, its profitability. Well, the same needs to apply to your retirement plan. You need the elements of a governance officer running your plan, because you're going to have multiple vendors providing services and receiving compensation. You're going to have a record keeper running the plan, which means you're going to have a plan document there. You're going to have an investment advisory firm overseeing and running the investments. You're probably going to have an investment policy statement that outlines that. Your assets might be custodied somewhere, so you're going to have a custodial agreement there. You might have a third-party administrator. You might have an actuary. They're going to have contracts. You might actually have a fiduciary, co-fiduciary on your plan. They're going to have a contract, okay? So you can kind of see that in any plan that we take a look at, there's anywhere from 3 to 6 documents that are running the plan. And unfortunately for you, most of those organizations, if they're not forced to synchronize, they write those documents in their own silos. And as you probably well know, documents are contracts. And the only thing worse than not having, a documented contract is having one that you're not complying with. And those are the elements here that we're talking about. So selecting and monitoring the plan providers is key. Overseeing the investments is important. Operating the plan according to the governing documents is key. And what we do for you is we analyze each of those documents and we synchronize the language there. That's called a plan governance review. So for those of you that have existing plans and you haven't had a governance review done, Mac and Phil provide that service, and we're their back office for that. We tear it apart with an agnostic third-party eye and see if there's inconsistencies or glaring errors. Like I talked about, you read about, excessive fee lawsuits in the industry. Yeah, they're about excessive fees, but what they're really about is somebody at the governance side of the equation was asleep at the switch and had an investment in their 401k or 403b or whatever it might be, where they could have had the same investment at a lower cost price based on the size of the plan. That's the English translation for what these excessive fee lawsuits are, and their governance lapses more so than anything. Of course, you can always have conflicts of interest. Conflicts of interest are not the end of the world, so long as they're identified, disclosed, and then properly mitigated along the way. So plan governance is a big deal. And plan governance, if I always say, having myself played football, believe it or not, through college, if you know what play the offense is going to run, it's pretty easy to create a good defensive strategy, right? we know what the offensive play that the DOL is going to call on you. And last year they tagged American businesses for $3.1 billion. I'll say it again, $3.1 billion in fines and penalties. And, a modicum of them were criminal. The rest of them were governance errors and omissions. So we know what the playbook is. And if you're working with us, we can run you through that playbook. So the next part of the presentation that we want to run through is taking care of your key employees. And I'm going to try to zip through this quickly, but the next slide talks about the special consideration. Again, we're focusing on pass-through entities in this organization, but this really applies to any organization. These pass-through entities, I said, are not treated as a taxpayer, and the earnings and losses passed through to the owner were then reported on the personal tax. So a non-qualified deferred comp plan, unlike the other plans that we talked about, are not deductible to the employer until they're taxable to the participants. So the earnings on the non-qualified plans are actually taxable to the employer unless we're using corporately owned life insurance or some type of strategy there. So there is the P&L impact to this, but remember what we're talking about here is if your organization and your concern is that, hey, I've got a few key people that I absolutely have to lock in and keep around, and maybe you're an owner-owned business and you're not going to give them equity, or maybe you're going to give them equity and they're just that important that you need to lock them in and keep them around, and Lord knows there's wacky numbers coming out on labor all the time, then a non-qualified deferred comp should be in consideration. Again, it's nothing more or less than saying, hey, I'd like to see more about this, and us drawing up a blueprint for you, knowing your specifics. So these non-qual plans, again, can be done in three really type of funding mechanisms. The next slide shows you those funding mechanisms. Before we get there, though, we're going to run you through our final ERISA Jeopardy question here to bring you into the home stretch. So how can plan sponsors ensure they have an effective plan governance process from our previous part of the presentation in place? Select one of the following. Is it A, they need to appoint a governance officer? B, they need to complete a plan governance assessment? Is it C, they need to conduct ongoing committee training? Or is it D, all of the above? How can plan sponsors ensure they have an effective plan governance process in place? We'll give you a moment to submit your answers on that one. All right, D was the right answer here. All of the above are good elements for plan governance, and then I'll get you into the home stretch here. But let's go back to our topic du jour about locking in key employees and the funding options. Remember, as I said, this is not about keeping more of what you earn in the short term and as far as the taxation, but it's keeping your business thriving and alive with your key talent. And I've never seen quite an environment like this right now for retaining key talent and the premiums that we have to be utilizing to keep key talent or attract them. But there's three primary ways that you can fund these things. One is an accounting entry, essentially. It's an IOU or a pay-as-you-go, where you're not funding it. You're just making a balance sheet entry, and you're going to pay that from working capital. And if you're a high and fast-growing company, this might make sense to you. The next would be to actually fund the program with a managed account or a sinking fund. Now, the gains and the earnings are taxable to the business along the way here. So, this can be attractive. But again, maybe the right-hand side of the equation is where we like to gravitate, and that's wrapping the investments through group insurance, corporately owned life insurance or bank-owned life insurance that has a cash value associated to it. So generally the gains on that are not immediately taxed, and the owners can actually participate in this approach as well too. So three different funding benefits. But if you're sitting here on the other end of the line saying, hey, yeah, this is resonating with me, we got to lock in a couple of key employees, and we're either not giving them equity or not enough equity or whatever the situation might be, then please follow up with Mac on this and we can run you through it. Here's a base example on the next slide. This is a rough case that came across to us. It was an organization, that did well, $10 million of 2020 revenues. As you can see, a fair amount of expenses there, $9 million in expenses. And, for a key employee, this was a solely owned business owner who's making $1 million a year, had a key employee that essentially was running the business, but had no equity in the organization. So this owner was kind of, I would call it on the back nine, if you will, and letting this person run the company, and there was material risk. So the owner was willing to make a $250,000 after-tax contribution into a rabbi trust as part of a non-qualified deferred comp plan. That rabbi trust was going to throw off earnings that was projected of 10 grand, which was going to be additional taxable income to the owner. Instead, it was wrapped in a corporately owned life insurance, which mitigated that further taxation. So again, you know, an after-tax contribution to the plan was made, but to limit the tax liability was wrapped in a corporately owned life insurance. So that's just a good example about what we can do on the non-qual side of the equation. And then our final section, and then I'll get into some of the stuff that's going on in Washington, Build Back Better, et cetera, is how do I, in general, with the rest of my employee base, key employees aside, create a more better, productive workforce. Well, you know, this is a softball here for the folks at Deschutes, because this is what they do, but it's not meant as one. The bottom line is the next slide will show you that a financial wellness program as part of your retirement plan offering is key. And a financial wellness program says, above and beyond all the things that we talked about today, about keeping more of what you earn, 199As, tax deductions, you know, et cetera, having the right plan designs is crucial. But part of your plan design absolutely should include something for your employees. Your liability strategy from a governance perspective is you have to be providing, and I'm quoting here, adequate information for your employees to make informed investment decisions about the investments in their retirement plan, 401k, 403b, whatever it might be. So that is your requirement. Now that's an ever-moving bar, you know, coming in case law. And, you know, what most organizations are now seeking and where we're going, you know, legislatively here and regulatory wise here is going above and beyond that minimum hurdle. And that's why many organizations are introducing what we call financial wellness programs, where there's a coordination by your retirement plan service provider, your consultants, working with your HR team to convey the benefits that are being offered across the board for your organization, and helping your workforce identify how to integrate that into their family structure or their home life structure that makes the most sense for them. The byproduct of what you get out of this, and there's been tons of surveys done, we do continuing education for the Society of Human Resource Managers, the SHRM people that are out there. And the surveys that we've participated with them on, we find that organizations that have financial wellness programs, the things that I ticked off earlier in the presentation, they have less folks calling in sick. They have less sick days. They feel they have an overall higher productive workforce. They have folks who are more prepared to retire on time, which in and of itself is appealing. But having financially confident folks who fully understand the benefits that you're providing as an organization is an extremely valuable part of your benefits offering. And financial wellness programs, you know, are now coming as part and parcel of a good offer on your retirement plan that's being offered, and it's being integrated in, you know, to the whole package, and generally is coming at no cost to you. So having a good financial wellness program is key. So that's the end of our formal remarks. I did try to end a little earlier, and we do have to keep you around until the top of the hour to get your CE. So Mac and I were chatting about this a little bit. Obviously, you know, post filibuster, we have Build Back Better that passed the House last night. And as I said, or I guess this morning, but as I said, you're going to see a different version of this in the Senate. But let me give you an idea of what's going to come down the pike next year for you as CFOs. You're going to have either as part of Build Back Better or more likely as part of the Secure Act 2.0, which is a bipartisan agreed upon part of legislation. Again, I sit on the Government Affairs Committee for the American Retirement Association, and all the folks on that organization are endorsing this. And here is what's coming down the pike that you're undoubtedly going to see. They might try to get it passed this year as a standalone bill. If not, it'll push into the first quarter, but I think there's a reasonable probability you'll see it done before year end here, depending on what they can clear off as it relates to Build Back Better. But you're going to see the following. If you have a new plan that's being established, or potentially if you change record keepers, you know, certainly any new plan that's being established is going to have a mandatory requirement for auto enrollment for all folks. Now, I don't think they're going to go back and write in that you have to auto enroll everybody in your existing plan, but it's being discussed. And certainly any new plans that are being established in an organization for now going forward are going to have mandatory auto enrollment into the plan for all participants. Now, folks, of course, can opt out, but they're going to all be enrolled in. Part and parcel to that, and here's a big question for you. As part of the Secure Act 1.0, we talked about the rear view mirror. The other part of the Secure Act, that 1.0 that was discussed was part-time employees. If you have part-time employees that are doing more than 500 hours of service and less than 1,000, this year you have to account for them and identify them. And in subsequent years, you're going to have to include them into the plan. Secure 1.0 is going to say after 3 years. Now, Secure 2.0 is going to say after 2 years. So theoretically, at the end of next year, any part-time employee who's doing more than 500 hours is going to have to be included in your plan. Now, you don't have to match them and vest them the same way as everybody else. They can be a separate class. Okay, but you're getting where we're going here. We're trying to, and Washington is trying to address this coverage gap and to make plans available and mandate that all folks get enrolled into the plan, including part-time employees. So if you have part-time employees, that's a practical takeaway from today's call. The next part of this mandatory auto enrollment is, what are you going to enroll them into? Well, you're going to enroll them into something called a Qualified Default Investment Alternative, a QDIA, and you probably already have one in your plan. And the easiest one to have in your plan is a target date fund, although you might also have a managed account or a balanced fund that's serving the same purpose. But your target date fund, or your QDIA, as part of Secure 2.0, being as we're going to mandatory auto enroll everybody into something, and you're going to auto enroll them into a QDIA, what the DOL is saying is you're going to have to provide a benchmarking analysis of your target date or QDIA as part and parcel. Now, if you're working with the right consultant, they're already doing that for you. But if you don't have, a recent benchmarking or analysis of your current target date or other QDIA compared to what's out there in the industry, you're going to be required to do it. So why not get ahead of it? And I'm going to ask you this question, which is a telling question. Who here on the line is a 2 retirement plan sponsor, and who here on the line is a through retirement plan sponsor? Who's a 2 and who's a through? And if you don't know what I'm talking about here, then you definitely need to be following up on this one. And the vernacular of whether you're a 2 or a through plan sponsor is a philosophical determination by you and the committee at the organization. A 2 plan sponsor basically believes that their fiduciary responsibility is to take your participants and your investments in your qualified default investment option are designed to take them to the point of retirement, age 65, age 67, whatever it's going to be. So the glide path or the asset allocation for that is going to be a lot more conservative and protecting assets design as they approach that age 65, 67. Now, if you're a through plan sponsor, then you're saying, hey, I believe we should be creating an environment to allow people to stay in our plan through retirement. And therefore, your glide path is going to be materially different because you're looking at keeping people in the plan well into their 80s, 90s, or maybe 100. So it's going to be a more aggressive glide path as they get to the point of to retirement. Now, the philosophical pros and cons there's no right or wrong answer, is I can tell you I'm a 2 plan sponsor. I don't want people in my plan, even if they worked for me their whole lives, which most of my people do. I want them out of my plan. I don't want them in my plan. I don't want the fiduciary responsibility. And, as I say in the South, bless your heart, that you work for me all the time. I want you out of my plan. And I provide services for them to understand their options to roll out of the plan if they want to. But other folks say, no, I want to create an environment that's a through plan environment. And you already, by the way, have made this decision based on the glide path of your QDIA today. So if you don't know what I'm talking about here, you definitely need to have a follow-up conversation. Are you 2 or you're through? And if you are a through plan sponsor environment, then there's a couple of things you're going to want to take note of. Number one, you can add a guaranteed lifetime income option to your plan with a safe harbor, meaning you can move people into, and that might be the one reason that would get me to be a through plan sponsor, is if the product set improves on these guaranteed lifetime income options, which they will. We're probably in the top of the second inning there. You're going to see more of these type of products come out. then I would consider being a through plan sponsor, because I have a safe harbor, meaning I can't get sued by anybody who stays through retirement if they're in my guaranteed lifetime income option that I had prudently selected with my consultant. So that's a big takeaway there. You two or through, you're going to have to submit a benchmarking of your target date or other QDIA to determine that it lines up with your mandatory auto enrollment and your philosophy. Okay. A couple of other things that are coming down the pike here in Secured 2.0. There's going to be a new catch-up contribution at age 60. We already have one at age 50 that I take advantage of. At age 60, you're going to be able to have a new additional catch-up contribution that's going to be available to those folks at their discretion. That catch-up is going to be in the form of a Roth, so they can tax you on your contribution. It'll be after-tax Roth. But hey, if I can get more money into a Roth environment, I'm all for it. But that is another feature of Secure 2.0 that's likely going to be included. The big one, though, that I wanted to talk about here is student loan repayments as part of your retirement plan scheme. You know, we're looking at Abbott Labs here, who got a private letter ruling on this, where they obviously recruit a lot of folks coming out of med school or whatever scientific degrees they might have that have student loan debt. So you are now going to have to not file for a private letter ruling. They're going to adopt Abbott Labs one and put it into Secure 2.0 that's going to allow someone at your organization who has student loans to go into your record keeping system and say, hey, I want to contribute X percent. They're going to be mandatory enrolled, and then they can increase or jigger around what their contribution is to their 401k or 403b or whatever it is. Then they're going to have a second side of it that says, do you have student loans? Would you like to make an employee deferral? And I stress that term, an employee deferral from payroll towards your student loan. Because this Secure 2.0 makes that contribution employee deferral, it will allow you as an organization the ability to consider matching it. And that's the big deal here. So you're going to be able to have, and your record keepers will have, and obviously your consultants at a premium here to make sure you have a record keeper that can actually fulfill this, the ability to have your folks contribute, defer towards a student loan, and you will have the ability to optionally match that student loan. One other final thing, if we have any not-for-profits out there, our schools and hospitals, 403Bs are going to be allowed to having collective investment trusts. And again, you're going to take a long, hard look at those collective investment trusts because they might be lower fees associated with the same investments of the funds that are already in your plan. So that's kind of the short list, if you will, of the future down the line. And we ran you through our requisite hour of presentation. Thank you for enduring that. Mac, thank you for bringing us on the line here, but I'm going to turn it back to Travis to see if any thoughts, comments, or questions, Travis.
Thanks a lot, John. We'll just have a couple of questions here for the sake of time. For anybody out there listening, if you still have something, feel free to take this time to submit it now. First question I have, the 199A deduction is a very intriguing topic to bring up with my clients. You did a great job of explaining the mechanics, but what is an easy way of bringing this up to my clients? Might be on mute there, John.
Oh, I'm on mute. I'm sorry. Yeah, the 199A deduction, pretty simply to me, is I ask, what was your qualified business income deduction last year, and what is it slated for to be this year? I try to ask basic, simple questions, and I know they don't know the answer to that. And at that point in time, I say, well, this is a big deal, and I have some levers that I can pull to try to make sure that you actually get one if you're willing to work with me and introduce me to your tax professional. So that's the way I introduce that one, Travis. I don't know if that answers the question there.
Yeah, it sounded good to me, John. The second one I have here, I'm interested in building my plan business, but don't feel confident yet in all of the retirement plan lingo and rules. Can RLC help in this area? Yeah,
that's what keeps us gainfully employed, is we certainly have a litany of content, webinar training, et cetera, to help you, understand all the ins and outs. And that's our job. Your job is to source cases, and our job is to be your back office to help you navigate the technicalities and come up with recommendations for you and your clients to consider.
Great. Well, that works for the questions at this time. Really big thank you to John and Mac for their time today. as well as all the rest of you out there listening. If you would like to continue this conversation, you can contact RLC or any of the other entities located here on this final slide. Again, for those of you seeking CE credits, certificates are usually emailed within a few days from RLC in the form of certificates@simplecert.net. So keep an eye on your spam/junk folders if it doesn't come through to your inbox. Lastly, as mentioned, keep an eye out for the follow-up email with supporting material. And when we close this webinar, there will be a short survey. If you can please take a moment to complete that, it would be greatly appreciated. Again, we appreciate your time and participation. Thank you all. Have a great rest of the day. Have a fantastic weekend and take care.